Financial Accounting, Chapter 8, Receivables, Part 3 of 3, building on the prior two parts where we discussed the method of estimating the uncollectible accounts or bad debts and the requirements by GAAP and the reasoning for the matching principle, among other details related to accounts receivable. This section is going to build on content, as accounting always does, and talk to you a little bit about notes receivable and accrued interest. First, before we go into those topics, let's talk real quickly about a comparison between the two methods, just kind of a quick review. 1, 2, remember I also called the analysis of receivables method the aging of accounts receivable method. Now this method is sometimes called the income statement method because you take the income statement amount and do a multiplication and you just plug it in. So if you've got $1 million worth of sales and you're told that 2% are uncollectible, you just do some multiplication and you plug in your debit for the adjusting entry and you plug in your credit. Again, remember, adjusting entries are AJEs. Second method emphasizes the balance sheet. Sometimes this is called the balance sheet method of calculating the allowance for doubtful accounts. And in this one, you're targeting a balance. Let me say that again. This one, you're targeting the balance sheet ending balance. And since there's already $3,250 in there, and since an analysis of the receivables shows that it should be $26,490, then we find this balance by targeting and plugging in what needs to be here to make this contra account have a specific ending balance. Again, doing homework problems, trying them without the use of your text is probably. So let's move forward then into the into the notes receivable, because they have an advantage. It's a note that's signed, it's formal, it has a stronger legal claim, and it's going to be written and have a specific face amount that says how much did the individual borrow from the company, with interest that's going to be charged at a date in the future whenever the entire amount is going to be due. Most of you did this type of calculation in high school. I've actually heard some students say they did it in middle school. So this is a review. This is what a promissory note would look like. We looked at this in part 1 of 3, but let's look at it again. First, we show in this that we've got a specific company called the maker right here. And then we show over here who it's being paid to. So it's got to be paid to this order. And the third item that we've got on here is the dollar amount of $2,000. It's issued on March 16th. And we have a due date of June 14th. We need to find out how many days that is. It is 90 days. And we have an interest rate, which is extremely important. And I want to say this, and this will help you for the quizzes. This interest rate of 10% here is on an annual basis. Interest is always stated on an annual basis unless something else indicates it's otherwise. So if you look at your credit card, you'll see 15.5% interest possibly. But sometimes whenever you get that credit card bill in, you see that they calculate interest daily based on your outstanding balance. And so they'll put daily interest rates on there, which come out to a very small percentage when you take 10% and divide it by 360. But at any, so how do we calculate the due date of a promissory note? Well, this is showing it to you by illustration. March 16th through June 14th is 90 days. Or you can look at the fact that there's 31 days in March, which means that there's 15 days left over since the note was issued on the 16th. And you add April and May and the 14 days in June to come up with 90 days. I think there's a homework problem or two related to this. It's doubtful this would be something you would see on an exam. but it is part of homework, and sometimes homework has a little more details than an exam will. Okay, as far as a notes receivable goes, let's talk about calculating interest. And this is a part you've probably done before. Interest is equal to the face amount of the loan, 2,000, 3,000, whatever, times the interest rate. So here's the 2,000 times the 10%, which is our interest rate, times the term divided by 360. Don't let this confuse you. It's a 90-day loan divided by 360. The reason they use 90 days is it makes the months even. If you were to ever use 365 days in a year, which of course we know is actual, that's not a problem either. It's an immaterial amount, but it makes us have better even calculations. So we find that the interest owed is $50. So whenever the person who borrowed the money repays it at maturity, that means whenever it's due, maturity is when it's due, then you add the two. So the maturity value is $20.50. The face is here, 2,000. The interest charged is $50, and the maturity value is $2,050. So let's look at a quick example. A company by the name of W.A. Bunn Company accepts, a company accepts a 30-day 12% interest rate loan dated November 21st to settle the account that this company owes them, and it's past due. So remember what we said in the very first part. Sometimes these notes receivable come whenever a customer is past due and they're required to sign a note. It's kind of an extension of time with interest. So the Bunn Company owes $6,000, and it's just showing here the swapping of one asset for another in this transaction. Let's debit notes receivable. Let's credit accounts receivable for the $6,000. At the due date, the calculation for interest has been done, and let's look at how that works. The $6,000 times 12% for 30 days divided by 360. And I think it would be wise for you to check the math on that yourself to make sure you're familiar with those calculations. That means that this company owes $60 in interest, and they will write a check or pay the cash of $6,060, which the business will debit cash, credit the notes receivable to show that the company paid their debt, and we've got some interest revenue. So now suddenly we're affecting revenue by recording a different type of revenue. Not fees earned, but interest revenue. Okay, this is a little tough concept, and I like to give students a heads up when something's going to be difficult. What happens if the money hasn't been received for the notes receivable and the year end has occurred? Well, we have to adhere to matching. Matching says revenues match expenses. So we get to record this revenue, even though we haven't received it yet. So if somebody borrows money for 6 months and they borrow that money on November 1st, if you do a quick check, November, December, January, February, March, April 30th would be the end of the 6 months. And if this company prepares financial statements on December 30th, they have the month of November and December where they've actually earned interest, but they haven't recorded it yet because they're not going to receive it until April. It's called accrued interest, and it's an adjusting entry. We learned about those in Chapter 3. So let's talk about interim accrued interest. Crawford Company issues a $4,000 90-day 12% interest note to settle an accounts receivable. So if they do this on December 1st, only 30 days have passed from December 1st to December 31st. So they've got some interest coming to them that they won't receive until the end of the 90-day period, but they get to record it. So it's that same concept of revenue recognition. Companies recognize revenue when it is earned, not when it's received in cash. So if we're preparing our December 31st adjusting journal entries, because we're getting ready to prepare financial statements, then on December 31st, we have to record the following entry. Okay, on December 1st, we show that we have a $4,000 accounts receivable swapped off for a notes receivable. So we credit one asset account and we debit the other asset account. Our adjusting journal entry for accrued interest on December 31st takes the $4,000 at 12% times 30 days. And so we legitimately get to record a new account that you may not be familiar with called interest receivable. So now we have accounts receivable, notes receivable, and interest receivable to show that we did in fact earn this revenue. This revenue is going to be included on our income statement. And we have interest receivable as of that date. So the theory, the concept is that on December 31st, if the Crawford Company came and paid their bill early, they would only owe $40. Now, this $40 really probably doesn't mean anything because it's not very much money. But for some companies, take a bank, for example, that has accounts receivable from customers for their mortgages, thousands of accounts receivable. This could be in the millions, in fact, in the billions of dollars. And so accrued interest is a very important journal entry that you will see on homework and you'll also see on your next exam. So what happens then whenever the 90 days has passed and we actually get the interest income? It's a little tricky. This is even a harder part. What we find then is that the total interest calculation is $120. 4,000 times 12% times 90 divided by 360. But since we've already recorded $40 as a receivable before December 31st of the prior year, and remember the prior year was 20Y3, then when it comes to March 1st, when we finally receive the $4,000 back plus interest, remember this $41.20 is our maturity value. When we finally get this cash, we go ahead and show that we no longer have a notes receivable and we no longer have interest receivable. And so this $80 in interest revenue is the amount that we earned in the year 2000 Y4. So $40 goes into one accounting period and $80 goes into the other accounting period, even though we don't receive our cash until March the 1st. And that March 1st date was done by calculating 90 days. Reporting receivables on the balance sheet typically is going to look like this. Sometimes we'll show the full amount. Here's our accounts receivable. We subtract out that contra account to show net. And on lots of companies, you're going to have a net accounts receivable. And that's all you're going to see. So this actually isn't the end of slide number 3. I've got another one because I wanted to provide an extra credit opportunity. Finally, an extra credit opportunity. For those of you that have stuck with this slide, this presentation for this long, I'm going to give you some extra credit. 20 points on any Chapter 8 quiz. So if you have 100 recorded on all of your quizzes, you're going to have 120 points on one of them. So I want you to do an internet search for Microsoft's annual report. And you have to make sure it's their annual report. You're going to find this same kind of information frequently on places like Yahoo Finance or others, but you have to make sure that you have found their annual report, and by doing an internet search for Microsoft annual report, you should find it. You'll be sure that this is their annual report because at the bottom of their financial statements, it will say, see accompanying notes. That's a GAAP requirement. And there will be footnotes that show details, which means just written notes to accompany the 4 financial statements. I'm going to have you locating their net accounts receivable for this extra credit and email me at boltc@citadel.edu with the following information for the most current year. First, the year end, meaning month, day, and year, and they do not have a December 31st year, so you'll have to let me know what month and day and year you've found, and it has to be the most current. After that, I want you to send me the total accounts receivable, the total allowance for doubtful accounts, and the net accounts receivable. So this is going to be a little bit trickier. You're going to have to go dig into their notes to see if you can find where they provide total accounts receivable and the total allowance for doubtful accounts. I usually do a Control F search to find the word doubtful accounts, and you'll find all the places that's located. And remember, subtracting this minus this will give you net accounts receivable. Finally, I want you to give me a screenshot of the page where you found the information, as well as the URL. So if you give me this information, I'll add 20 points to a quiz from Chapter 8, which should be helpful for everyone. And it's also very good practice for the annual report project that every student is required to do in BADM 212. Let me know if I can help.